In Trump's view, the economy works well when the stock market does well.
Wrong.
But a big reason stocks rise in value and don't fall as far as they would otherwise is stock buybacks. For years, corporations have spent most of their profits on buying back their own shares of stock, instead of increasing the wages of their employees, whose hard work creates these profits. Stock buybacks are artificial efforts to interfere in the so-called free market to prop up stock prices. Because they create an artificial demand, they force stock prices above their natural level. With fewer shares in circulation, each remaining share is worth more.
The gap between the average big company CEO and their typical worker was about 25-1.
Corporations were largely reinvesting in their innovation process, and in some cases, because of strong unions, paying their workers living wages.
But then something shifted in American corporate culture. It would eventually lead to the explosion of CEO pay that we've seen since then.
It was a complete revolution in the way American companies were run. There's a scene in the 1991 Danny DeVito movie, Other People's Money, that actually does a pretty good job showing this new way of thinking.
Make the stockholders richer. Are you going to liquidate New England Wire and Cable? And if so, what about the people who work here?
Danny DeVito plays a corporate raider who is trying to convince the shareholders of a small New England cable company to sell him their shares so that they can cash out when he liquidates the company.
You invested in a business, and this business is dead. Let's have the intelligence to sign the death certificate to our employees, to our community. What will happen to them? I got 2 words for that. Who cares?
He tells the shareholders that the company has done them wrong by not prioritizing their payouts.
They sucked you dry. And our stock, 1/6 what it was 10 years ago.
DeVito is styled as the kind of lovable villain of this movie, but he actually represents a way of thinking that was taking over American business at the time.
The way that we have thought about the purpose of the corporation since the Reagan Revolution is to make as much money as possible for shareholders.
We're going to turn the bull loose.
I refer to this as shareholder primacy.
In the movie, the shareholders eventually agree to sell to DeVito's character over the objections of the company's CEO. In real life, shareholders found a way to make sure that CEOs always put their interest above everybody else's. Instead of paying CEOs a salary in cash, like workers at the rest of the company, start paying them in company stock. The idea spread like wildfire.
Well, if one CEO starts to be paid in this new structure and you see their compensation go up very rapidly, that's going to spread very quickly across the entire ecosystem. It's like keeping up with the Joneses.
Something else happened when CEOs started getting paid in company stock, and it goes a long way towards explaining why companies like Lowe's won't schedule enough workers to help customers, or pay their employees like Felix a living wage. Remember those 3 options that Lowe's and other companies used to have for what to do with their profits? Well, in 1982, right before CEO pay started to really take off, they added a 4th option: buying shares of the company's stock. Here's how it works.
Let's say each share of Lowe's stock sells for $100 on the open market. Then the CEO of Lowe's decides to use some of the company's profits to buy back some of those shares. Now, all of a sudden, with fewer shares remaining, each share is worth a bunch more. Ta-da!
If this is reading to you like some kind of scammy corporate magic trick, you're not wrong.
For much of our history, stock buybacks were illegal.
The lawyers of big companies knew that a company could be accused of manipulating its market price if it went ahead and did stock buybacks.
That changed when Ronald Reagan was elected in 1980 on a platform of deregulation, and he picked a Wall Street executive to be the head of the SEC. And that SEC chair decided that allowing stock buybacks would help companies that wanted to enrich their executives and their shareholders without really having to do anything to improve their performance.
The Schoolhouse Rock theory of investing holds that in order for a company's stock price to go up, they have to actually do something, like increasing their pollution. I mean, their sales.
Looks as if their sales are going up sky high. Better call my broker and tell him to buy.
But with buybacks, corporations can raise their stock price without actually doing anything. I mean, just put yourself in the shoes of the Lowe's CEO. Nearly 80% of your annual pay is in company stock, And you get a $3 million bonus if the stock price hits a certain level.
Your workers created nearly $7 billion in profits last year.
What do you do with the money? Use it to make a bunch of your part-time workers full-time so they can help customers? Gotta pay the shareholders their dividends. Don't want to get fired. Use it to pay your employees a living wage so they stick with the company longer. Or use it to do a massive stock buyback, which literally makes the shares that you own worth more and ensures that you get that $3 million bonus.
Why wouldn't they? If you put an incentive structure in place where CEOs legally manipulate the market price of the stock that directly and indirectly affects their own compensation, why wouldn't they?
They can inflate their own paychecks without having to do anything to improve company performance.
Stock buybacks are a huge reason why the pay gap between CEOs and their workers jumped in the 80s and 90s and has stayed high ever since.
You've seen consistently companies like Lowe's or Walmart or Starbucks where workers have been organizing. They have billions of dollars going out the door in stock buybacks. They say they cannot afford to pay their workers even a very, very low basic wage.
They're literally buying back their own stocks. It's hard for me to understand, but it's clear that if they're doing that, they got some coin to throw around and they're getting paid however many hundreds of dollars per hour. And yet, my coworker who has worked at Lowe's for 20 years is making less than 15. It's almost like laughable. It's obviously incredibly offensive.
When companies started paying their CEOs in stock, it helped kickstart a massive nationwide transfer of wealth from workers to CEOs and shareholders. More recently, that wealth transfer has gone into overdrive thanks to one specific law.
Another huge turning point was the 2017 tax reform.
The biggest tax cut, biggest reform of all time.
Now, as Trump and the Republicans are working overtime to make these tax cuts permanent in his big, beautiful bill, it's easy to see how it'll supercharge this wealth transfer from workers to CEOs, because we already have all the evidence.
The